Okay, so give me a second. Yeah. So good evening, guys. My name is Maurya Hanspal, and in this session, we're going to continue our sessions on wealth management. So in this session, I'm planning something to talk about the direct equities versus the equity funds. But what is the difference between if you are investing in direct equity versus you are investing into equity funds? So what exactly is the difference between the two? Direct equity is when you are investing into the direct stocks by yourself and no AMC is involved or no other intermediary is involved. Like you take a platform, you download or like you make a demat account in HDFC, like which are the traditional brokers, or maybe the discount broker like Zerodha, Upstocks, Grow, Angel, 5 Paisa. Like there you open and you are like doing the stock picking on your own. And equity funds is nothing but investing into the mutual funds, that is like which comprise equity stocks. So that is the major difference between the two. So when you are investing into direct equity, make sure that you have the expertise to be invested into the direct equity. Until and unless you don't have any expertise to invest in direct equity, you cannot do it. That is why the people who do not have time to manage their own funds or invest in equity, they invest in the equity funds with the help of a mutual fund manager. Okay. Then you have the equity mutual funds, जो हमने अभी बात करी. Then the passive and active funds. The passive funds, as I talked about, the passive funds are those funds which like replicate an index. For example, Nifty or Sensex. Like if Nifty has been giving a return of 12% over like 1 year, then the mutual fund will also attempt to give a return of at least 12%. But it won't cross 12%. And when I talk in the practical scenario or in the practical way, the return won't be 12% also. It would be like 11.80 or like 11.90 because some of the money is eaten in the form of the expense ratio. So the index funds, first of all, they cannot beat the index, and the second fund they cannot even match the index as well. Okay, but for a safer strategy, it is good to like invest in index funds because more than 50% of the active funds have not outperformed the index also. Like sometimes they might outperform in 1 year and 2 year, but in the long term they do not. If the market is giving an average rate of return of 12%, these active funds will also give you a rate of interest of max to max till 12% or like 11.8 or like 11.7, like that be just like the index funds. And sometimes also since the active funds like which are basically maintained by the portfolio manager or the mutual fund manager, the expense ratio tends to be high. So that can further eat your returns. So in most of the scenarios, the index funds they tend to give you like more return. Then you have the diversified equity funds. That is like you are investing into the equity funds which are diversified across various sectors. Which are like diversified across various sectors. Then you have the based on the market capitalization. Like when we talk about mutual funds, like you can have further categories. Like a mutual fund can be investing into only the large cap. That is like who is having the market capitalization of more than 20,000 crores. There can be some mutual funds who are investing only into mid cap, whose market capitalization is from 5,000 to like 20,000 crores. And whereas there can be some mutual funds whose market capitalization is less than 5,000 crores. And those are the small cap funds. So either the mutual funds can invest individually into like these three categories, or they can have a multi cap funds like which can invest into all this. But the restriction posed by SEBI was you can just invest like 25% in large cap, 25% in mid cap, and 25% in small cap in case of a multi cap fund, and the remaining 25% of बचेगा, so that can be allocated as per you. Okay, but in flexi cap, like there is like no such limit. You can invest as much as you want in how many categories you want. So in some case, like people talk that the flexi cap are like much better than this one. Then based on sectors and industry, like we have already talked about. Like if someone is investing like only in the pharma sector, only in the auto sector, or only in the hospitality sector, so that is again a good diversification, but that diversification is concentrated, that you are investing just into that only. Okay. Then they're talking about based on the themes and investment style. By themes, I mean some new themes are coming up in the market, and we might have like talk about these funds like which are coming up by a lot of AMCs, the emerging equities funds, India's opportunity funds. Okay, so like what are these funds including? The disruption funds. So these funds are basically including the new edge themes like which are coming up in the market. Like for example, a fund might just involve the IT companies and not the traditional IT companies of Infosys or TCS or Wipro. The new age IT companies, Zomato, Nykaa, your Policy Bazaar, your Paytm, and all these like disruptive businesses like which are into like which have come into the businesses for like disrupting the eco space and all. Or there can be some team like which are investing into the EV theme. There can be some like which are investing into the batteries fund, like which batteries can be used for the EV themes. There can be a fund which is investing into the metals like that are used. There can be a pure like metal set like which are investing into EVs. There can be something like which is into like they are taking the opportunity of the clean energy, hydrocarbons, and renewable energy. So these themes like which are coming up in the market. And nowadays, like we have also been seeing small case funds. So small case funds are taking the opportunity, all the new opportunities, all the emerging opportunities that are coming up in the market. And those companies which are catering to these, like they have their own funds talking about the rural sector theme. They have their funds talking about the battery theme, EV theme. Even they came with a new portfolio talking about those companies which might get beneficial due to the budget 2022. So on the basis of that, like they're creating their own small cases. But a small case is almost same as a mutual fund, but the difference is you can buy and sell. And the shares that you will have, like you can buy and sell these shares, and you can like balance your portfolio on your own. And also the shares would come in your demat account instead of the demat account of some other person. Then based on like investment style, we talked about the active and passive fund. Then you have the open equity funds are classified open-ended funds. Matlab like those funds can be redeemed anytime. Okay. So when you talk about the open-ended equity funds, there are two types. One is the value funds, and and the other is the contra fund. Nowadays, a lot of debate is being going on between value and growth. So growth funds are basically like which have like when the inflation is very high, basically the growth funds are hurt the most because at that time, like the rate of interest rises, basically the risk-free rate rises, and the risk-free rate is one of the most important component to determine what your cost of capital. And when you calculate the market value of the share, so that is nothing but the market value of the share divided by the discount rate. So discount rate jitna zyada hoga due to the increase in the interest rate by Fed or anyone else, the market price of those basically the growth stocks would come down. So basically the growth stocks are one like who possess high earnings and जिनकी growth हो रही है. Whereas the value stocks are the ones who have like a good growth in future but immense value right now. If you can buy those stocks right now, you might earn some huge returns in future. That is one thing. Contra funds. Contra fund is something that follow a contrarian strategy. For example, if the market is rising, okay, like they will like sell the stocks. If the market is falling, they would buy the stocks. So they're going against the market fundamentals, right? Then you have some stock like which focus only on dividend yield. That is on the dividend that you are getting. Basically, the PSU companies are held in the portfolio for the purpose of dividend. Like most people hold PSU companies or the public sector unit companies for the purpose of dividends. Okay. But whereas a large number of the other mutual funds have also been created for the purpose of dividend as well. Then focus funds are someone like which are investing into like limited number of 30 stocks in the portfolio, just focusing on those particular stocks only. Then equity linked investment scheme is a good one because 80%, at least 80% is going in equity. And under section 80C, that they are also giving you a tax deduction of up till like 1,50,000, the maximum tax limit tax deduction you would get. But it has a maximum lock-in period of 3 years. You can like redeem it, but some transfer charges would be there. Then diversified versus concentrated funds, I told you. If you are just investing into one sector, be it only pharma, be it only IT, or only FMCG, it would be a concentrated fund. But if you are trying to diversify into different fields, it would be a diversified fund. Index funds I talked about. See, in index funds now, you might face a tracking error. That is, your return might give you some less return as compared to the index one. So that's a tracking error. Like for example, if Nifty has given you a return of 15%, index fund, your index fund is giving you a return of how much percent? 14.5%. So that 0.50% is a tracking error, and that's a negative tracking error. Exchange traded funds I've talked about in the previous session. Yes, so nowadays some gold ETFs are also coming up in the market. Your basic like the gold bees and on gold bees, nifty bees. Bees are the benchmark exchange traded funds. Okay, like you can buy and sell. So basically the concept is it's a mutual fund type and it is like just it has gold, मतलब कि gold within it. Like whereas the concept of ETF it remains the same. Okay, so that is one thing. And nowadays the gold ETF has come. So gold ETF is the older one, but now a silver ETF has come, and people are like buying that silver ETF. And 99%, at least 95%, yes, 95% would be like invested into silver and silver related instruments in case of a silver ETF. Yeah, that must be like clear to you. Then one thing I wanted to discuss with you, I'm just taking it out. Okay, yeah, gold ETF, silver ETF we have talked about. Then you have the Bharat Bond Exchange Traded Fund. So our Bharat Bond Exchange Traded Fund were basically using your government bonds and securities, like your government protected bonds and securities. And they created an ETF out of that. And again, the government securities are what? Like the safest ones. Then how to calculate the NAV of the mutual fund? That is your net asset value. So your net asset value is nothing but what? Your net asset value is, I'll just type it down here. Yeah. So when you calculate your net asset value, NAV, it is your total assets minus the total liabilities of your funds divided by the outstanding share or the number of units. That's your NAV. फंड के पास जितनी एसेट्स हैं जितने लाइबिलिटीज हैं डिवाइडेड बाय द टोटल यूनिट्स एट द फंड इज हैविंग, मतलब कि कितने यूनिट्स हमको मिल रहे हैं. दैट इज योर एनएवी, द नेट एसेट वैल्यू. एनएवी ज्यादा होगा तो ये कम होगा, एनएवी कम होगा तो ये ज्यादा होगा. बट इट इज नॉट मैंडेटरी कि मतलब आप एनएवी देख के भी जाओ, बिकॉज ऐसा भी हुआ है कि एनएवी ज्यादा हुआ है, ठीक है, एंड रिटर्न तब भी सेम रहा है, एंड एनएवी कम हुआ है एंड रिटर्न तब भी सेम रहा है. तो फोकस ऑन द फंड परफॉर्मेंस मोर rather than the NAV, the net asset value.